Everybody, this is the second lecture for week 8. In the previous lecture, you have seen the approach of pricing based on the cost. So in this slide, you will see another type of or another approach of setting price. So it is about target costing and pricing. Target costing is a method of determining the cost of a product or service based on the price that the customer are willing to pay. Using this approach, the price of a product is set based on the amount that customer are willing to pay. So using this approach, the manager or you has to focus on the customer. So see the yellow box there. Target costing involves much more upfront work than cost-based pricing. So if you choose to use this target costing and pricing method, you have to do more work. You as a manager or accountant has to examine the customer preference. However, if cost plus pricing turns out to be higher than what customers willing to accept, additional work or lost opportunity will result. So there is a problem with the target costing. The problem is, let's say the amount that the customer are willing to pay is lower than the cost. So there is a problem. When the amount that the customer are willing to pay is lower than cost, then adjustment has to be made. Otherwise, the company will making loss. So see here, there are several things related to cost and pricing policies. Other pricing policies. These are like strategies used by companies when they set price for their product. Okay, see one, penetration pricing. The pricing of a new product at a low initial price to build market share quickly. Many companies use this approach or policy when they want to penetrate. When they want to build market share, they offer very low price for their product. Like many years ago, the thing that happened is the only chocolate drink that we have in Malaysia, or malt drink that we have in Malaysia, is Milo. And then at one time, Ovaltine want to penetrate the market. So at that time, when the company that sell Ovaltine want to get the market share, they sell Ovaltine at low price compared to Milo. So I think after several months or maybe 1 year, the Ovaltine got some market share. So that is the way the policy that they use. When a company want to get market share, they will use this policy, penetration pricing policy. Okay, the second policy, price skimming. A higher price is charged when a product or services is first introduced. And this is another policy used by many well-known companies. Companies like Apple and Samsung, when they introduce a new edition of their product, for example, I think Apple 12 or something now. When they introduce the product, the price is very high. when they firstly introduce the new edition of the product. Their target is people who are willing to spend and have the ability to spend a lot will purchase this product when they release or introduce it. And then after a while, maybe after 1 month or 2 months, they drop the price a bit so that other people in the market can also purchase their product. There is one strategy to when they set higher price at the time they release the new product or new edition of the product. They will get back their cost that they have invested quickly. That's the main thing. They want to get back their cost that they have invested quickly. After that, they just hope to maximize profit from the product that they introduce or sell. And the third policy is price gouging. Occur when firms with market power price products too high. This is practiced by a business or a company that has a monopoly power. That's why in many countries now, they do not allow a monopoly company or a monopoly business. A monopoly business always charge very high price for their product because they have no competitors. Okay, this is predatory pricing. See here, predatory pricing is the practice of setting price below cost for the purpose of injuring competitors and eliminating competition. The situation is like this. The thing that can happen is, let's say there are several companies in the market. There are several companies that sell the same thing, the same product. So, and then one way for a company to eliminate its competitors is to sell their product at a very low price. When they sell the product at the very low price, people will only purchase the company's product and will not purchase other competitors' product. If this thing happen for several months or maybe a year, the competitors will not survive. So this predatory pricing can be done by a company that has enough capital to invest to do that. They have to suffer loss in the short term after the competitors after there are no more competitors in the market. The company that practice predatory pricing can monopoly the market, and they will start making money by setting the price at any amount that they want. So the predatory pricing is unethical in maybe something that against the law and regulation in many places now. Like I said earlier, now in many countries they have anti-monopoly law and regulation. See here in the previous slide, there is a difference between the penetration pricing and the predatory pricing. Penetration pricing is a strategy where a new business want to enter market and charge low price. But predatory pricing is done because the existing company want to eliminate the competitors. So that is the difference. Predatory pricing on the international market is called dumping, product dumping. If you read business news, many years ago, there is one country do product dumping or market dumping. They export their product very cheap to other countries to eliminate competitors. That is not good practice. It is not an acceptable practice, because if they do that, the local businesses will suffer because of the product dumping. I suggest you read more about the product dumping, predatory pricing on the international market. Okay, this is another thing that you have to know. This is a very good knowledge, very useful knowledge when, especially if you are planning to start a business in the future, and also if you are a management accountant in the future. This is very useful. You have to know this. Okay, then another thing that you have to know is price discrimination. This thing happen. Price discrimination refers to the charging of different prices to different customers for essentially the same product. Cobalt Incorporated manufactures vitamin supplements that cost an average of $163 per case. Cobalt sold 250,000 cases last year. As follows. See, the product is almost same, or essentially the same product, but the company charges different prices to different market, or to different customer. See here in this example, the almost same product is sold to large drugstore chain for $200 per case, or per unit maybe. Cases sold is $125,000. So it means that this company sold its product cheaper to large drugstore chain. But for small local pharmacies, they sell the same thing at $232, and to the individual health clubs, they sold it at $250. This is called price discrimination. It happens everywhere. One company, if the one of the thing that can happen is like this. Maybe one of the reason the things happen like this is a large drugstore chain, they purchase in high quantity. When they purchase in high quantity, the company is willing to give them lower price. Small local pharmacies is in the middle. They purchase in not very big quantity, but they still purchase a lot. So they get $232 per case. And then individual health club, most of the time is small organization. They purchase in small quantity. That's why they have to pay the highest price for almost the same product. It happened in many places. In Malaysia, it happened too. If you go to if you check suppliers in Malaysia, I think they practice almost the same thing. For their preferred customer, they sell it at low price. Customer purchase in cash, they sell it at different price. Individual customer will get different price. So that is the way they do it. COBEL is practicing price discrimination. Okay, so that is about the pricing. So now we are looking at measuring profit. This is another subtopic in this chapter. Profit is a measure of difference between what a firm puts into making and selling a product or service and what it receives. Not everybody knows about profit. So the main objective of starting a business is to make profit. The main objective of all business organization are making profit. The main objective is making profit. If the objective is not for making profit, then that is not a business. That is a charity. Okay. So in accounting, that is the thing that we have to understand. Okay, now then it is very important to measure the profit or to calculate the profit. So the basic formula that we use in accounting to calculate profit is revenue minus cost and minus expenses. Okay, let's see here. Profits are measured to first determine the capability of the firm. This is the purpose of calculating profit. First, to measure the capability of the firm. To check whether the firm is performing well or not. In accounting, the measure is very simple. If a business is making profit, then we can say that the business is performing well. If the business is making loss, then we say that the company is not performing well. The second reason profits is measured is to measure the managerial performance. That is one way. If in the future you have a business and then the business is getting bigger, you have to hire a manager to manage the business. Then how to measure the performance of the manager? One way is to check the profit generated by the business. If the business is making high profit, then you can say that the manager is performing well. If the business is making loss, then you can say that the manager is not doing well. Okay, number 3, determine whether or not a firm adheres to government regulations. In some industry or sector, government set the price for the product or something, and then so if the company make more than the regulation set by the government, then maybe the company can be said as not following the government regulation and law or something. Number 4, signal the market about the opportunities to others to earn profit. And so the thing is like this. If you see that a business and this business has a product, and then this business every year making very high profit consistently every year, then what it shows, the situation shows that there is opportunities for others to also produce and sell the same item. Like many years ago in Malaysia, we have like several telecommunication business, several mobile phone provider, and this mobile phone provider is consistently making high profit every year. So when this happen, it shows to other people and it shows to other companies that a mobile service provider is a very good thing to start a business by providing the mobile service. That's why, like I think maybe many years ago, there are only 2 or 3 mobile provider, telecommunication provider. Now we have, I don't know how, but there are too many. The main are some Celcom, Maxis, and Digi. That are the main, the biggest, I think, companies. But we have many small companies that also provide mobile communication service, and this they enter the market because they know this market is very profitable. So profit is a signal to other people that the market is a good one to enter or not good one to enter. Okay, measuring profit. I think in this slide you will see 2 approaches. One is called absorption costing approach. It is also called full costing, required for external financial reporting, and assign all manufacturing costs, direct material, direct labor, variable overhead, and fixed overhead to each unit product. So each unit of product absorbs same sum of the fixed manufacturing overhead in addition to its variable manufacturing cost. Okay, so absorption costing. So this measuring profit approach. First one is absorption costing. Absorption costing means you use the income statement that you have learned in financial accounting. That is absorption costing way of calculating profit. The basic format is revenue minus cost of goods sold. You will get gross profit minus expenses. You will get the net profit. That is absorption costing approach in calculating or measuring profit. When you see this income statement, you will know that this way of measuring profit or calculating profit assign all manufacturing costs to each unit of product or to the cost of goods sold, and then after the revenue is the company calculate the revenue and then minus cost of goods sold. The cost of goods sold are all manufacturing costs, and then minus non-manufacturing costs, and then the company make profit. Okay, this is one approach to calculate or measure profit. Another approach is variable costing approach. It is also called direct costing. And then using this approach, assigns only unit level variable manufacturing cost to product. These costs include direct material, direct labor, and variable overhead. And then fixed overhead is treated as period cost and is not inventoried with the other product cost. It is expense in the period incurred. Okay, variable costing approach. There is an income statement for this approach. The income statement is like this. You have to show total revenue first, and then minus total variable cost. The total variable cost include direct material cost, direct labor cost, and variable overhead cost. And then after that, revenue minus the variable cost, you will get an item called contribution margin. After you got the contribution margin, you have to minus fixed cost to get the net profit. So this way of calculating profit is called variable costing approach. Variable costing approach is preferred by most managers because using this approach, the manager can see clearly how much is the variable cost and how much is the fixed cost. when the manager can see clearly how much is the variable cost and fixed cost, they most of the time can control the cost easier. Most of the time, variable cost can be controlled. It is easier to control the variable cost, but difficult to control the fixed cost. Fixed cost is always fixed. In the long run, you can change the fixed cost, but in the short run, it is fixed. And also, if you calculate a profit using variable costing approach, and you use the income statement for this format, most of the time very easy for you to see the numbers, and you can see clearly what are the variable costs and fixed costs, and then you can do many business decision. You can do many business decision analysis using the data that you can see in this format of profit calculation or profit measurement. Let's see if I have. Okay, there are several limitations of profit measurement. Limitation of profit measurement include: first, focus on the past performance. So if something about the profit is, when you calculate profit, it shows the thing that had happened. For example, the year is year 2020. You want to calculate profit for the year 2020. So the thing that you do is you calculate total revenue for year 2020 and minus the revenue, the expenses for year 2020, and minus cost for the year 2020. So the profit number shows the thing that had happened. But you as a manager or maybe investor, you want to know about the future. So when you see the profit figure, you always have to aware that the profit figure shows the past performance. And the second thing, the limitation is uncertain economic conditions. So okay, the thing is like this: profit is a number that is useful to show the performance of a business, the performance of a manager, etc. But always you have to aware that profit also determined by uncertain economic conditions. Profit is not determined by only things that happen or people that in the business only. Profit of a business is not determined by things that happen in the business, and also not totally depend on the workers and the managers of the business only. But you have to aware that the profit of a business also determined or influenced by external factors, like the general economic condition. Like now, the thing that happened now, maybe the thing that happened now is we have COVID-19 lockdown. So some companies, they are very good. The people are good. The products that they produce are good. Everything is good, but they still cannot make profit. Why? Because the external factors. Now they cannot open their shop like usual. They have to limit their opening hours. Also, they have to limit the number of the customers that can enter their business. And also, even if the shop is open long hours, people do not want to go out. People are not happy to go out now. People are very scared with the spread of the virus. So this shows that profit is not the results of internal matters only, internal business matters only, but it is also influenced by the external matters or economic condition. Number 3, difficulty of capturing all important factors in financial measures. So this one is also related to the point number 2. But okay, the thing is like this. In general, we say that in accounting, if a business is making profit, then we say that the business is good, the manager is good, etc. But you have to aware that the profit only related to things that can be measured in terms of dollar and cents only. Some companies, the companies are good companies. Like they have good location, good customer service, they have high customer loyalty, etc. They are good, but at one time or in one year or something, they do not make a high profit. So that is the thing that we have to aware. The profit only related to matters or things that can be expressed in terms of dollar and cents. And we have to aware that a company, there are many things that we have to consider when we want to say the company is good or not. Things like location, customer loyalty, brand loyalty or something. So this thing also have to be considered when we want to say the company is good or not. Okay, successful firms measure for more than accounting profit. So this is one very important point. When you want to make conclusion whether a company is good or not, or success or not, looking at the profit is only one way. You have also to look at other things other than profit. Like I said earlier, location, customer loyalty, brand loyalty. There are many things. So always aware about that. In the future, if you are a management accountant or a manager or investor, always you have to aware it is not only profit that you have to look at. You have to look at many factors when you want to say the company is a good one or not. Thank you very much. This is the end of this lecture number 2 for week 8. If you have time, if you watch this lecture and still you have time during the lecture hour, I hope you do revision and that is for you to prepare for the coming mid-semester test. Use the eConnect system, do all the smart book readings or something that I have set in the system, and also do all the exercise, all the sample questions that you can see in the textbook. I think I have given homeworks, so if you see that there are homeworks, you do that. And I think I have said that every time you do the homework, after you answered a question, you can see the true answer, and then also you can see there are hints. Maybe the system also shows what is the thing that you have to read in the book related to the question. So it helps. I hope it helps you to prepare for the coming mid-semester test. Thank you very much. Do not forget to write your name and matric number in the comment section. I will take it as the attendance.